Good afternoon. Welcome to the weekly Livestock Market update. I am Brownfield anchor reporter Megan Grubner. With us as always to talk all things markets, University of Missouri, Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
We might be a day late, but we will never be $1 short.
We're going to give more content given we have a little more time. That's right.
Well, we don't have that much more time. I have a plane to catch and two little boys at home who are very anxiously awaiting my arrival before bedtime tonight. But we do have much more time than we normally have on a Friday afternoon. We are a little bit late. We had some scheduling issues yesterday. I'm at Commodity Classic in Orlando, Florida. Scott is in Missouri, so sometimes that travel and on the road game doesn't work as well, but we are thankful to be able to do this on Saturday morning. It's almost like old school Saturday morning cartoons.
Who am I?
I'll let the audience decide. Maybe they can, if they're watching live on Facebook, drop in their suggestions to which cartoon character you should be. And we can have a poll at the end of the chat today. All right, we're going to talk supply and demand numbers. We're going to talk monthly trade data. Jobs report came out yesterday as well. But to kick things off, let's recap what happened this week in the markets.
Yeah, Megan, on the cattle side this week, fed cattle were 40 cents higher this week. You know, that actually puts them nearly $27 a hundred over where they were a year ago at this time. So much higher cattle prices. And you know, I've talked a lot about why that's happening. Feeder cattle as well, strong this week, $2 to $4 higher across those auction markets this week. On the futures side, the April live cattle futures contract was down nearly $1.20. Yet the April feeder cattle contract was up $1.55. I think as the May corn futures fell 22.5 this week, that helped give some strength in those feeder cattle futures. Box beef was down $1.90 this week. When we switch gears to the hog side of the equation, barrels and gilts cash prices this week were 85 cents higher. The April lean hog futures contract was up $2.75 this week. And the pork cutout value was up nearly $2.25. Strength across the board in all those components on the cutout value.
I feel like this is an opportunity to sneak in a slight risk management conversation, especially looking at what's going on with cattle prices, but also what's going on the corn side of things as well, because we've seen a slide on corn prices recently.
Yeah, I would. So this is a great opportunity to think about when do I want to really cut off that downside risk. And you and I have talked a few times. I often talk about LRP. It's a subsidized put option that, frankly, if you get a little bit out of the money, Megan, you can get some relatively inexpensive insurance. Of course, that puts your downside target a little bit lower. But we could. All right. So I keep saying, you know, we get out here in this summer and talk about dry weather, we likely push corn prices much higher than where we sit today. And I think that's then tough for feeder cattle prices in the fall, or could be. And so being able to protect that downside risk, there'll be opportunities, especially if corn continues its trek lower, as you know, USDA gave us another, I believe, 75 million bushels of corn ending stocks for the current year, which I think drove those prices and on the future side lower this week.
Interesting comment. I spoke to a cattle producer from South Dakota who's had a pretty good, he's in the western part of the state, and has had a pretty good fall and winter in terms of precipitation. In his outlook, thinking about weather and precipitation is much better. And he said if there's a solid spring, solid summer in terms of moisture, it could maybe speed up their expansion thoughts a little bit. And I would assume that's going to, at least in the short term, pull out some of the available feeder supply, right?
Correct. So you very well remind us that it does cut both ways. So I hear those anecdotal stories as well. I'm really curious to see how this year does unfold if we have much better weather in some of those worst drought areas. But if they do choose to rebuild, those heifers will come out of the current supply of beef, and that could make cattle prices, I think, even higher. So there's a lot of uncertainty here as we continue through 2023. I tend to think we're going to be slower in rebuilding the herd this time relative to where we were in 2014 and 2015, more because although we might get record cattle prices, I'm not sure costs will give us record profitability.
And nice preview too, a little preview or a little promotion of livestock, the LRP program. We will have a webinar in our bottom line series on Brownfield, which we're partnering with the National Cattlemen's Beef Association, focusing specifically this upcoming Tuesday on LRPs. So you can register for that on our website, which is at brownfieldagnews.com. All right, enough of some self-promotion, shameless plugs. Let's talk slaughter numbers as we take a look at both cattle and hogs for the week.
Yeah, so Megan, for the week ending March 11th, USDA tells us a run of 634,000 head of cattle this week. That's up 5,000 head from where we were a week ago, but down 3,000 head from where we were a year ago. On the hog side, a run of 2.497 million head of hogs this week. That is down 15,000 from last week, but up 25,000 from where we were a week ago.
It's interesting watching what's going on the slaughter numbers, especially had kind of anticipated we would start seeing a slowdown on the cattle side of things, but there's not been, we've not pulled off the gas a bunch just yet.
Yeah, that's right. And I think that's a good reminder so, when you look at cattle on feed that we've gotten both Jan and Feb 1 on feed numbers, and those are well below year ago levels, but those are really the first couple of months. And, so we got to get another 3, 4, 5 months down the road before we really start seeing, I think, the bigger hole in slaughter ready cattle. So it's coming. You and I have been anticipating this for several months, and we're just not quite to the cusp of it at this point.
All right, let's talk supply and demand. Big report this week, big report, but that would be the big report for us in terms of information coming out of USDA. Where do you see the biggest changes month to month?
Yeah, so I think on the livestock side, first, the really biggest change we saw was USDA raised their estimate of beef production 170 million pounds this month. That still would put it 5.7% below where we were in 2022, but last month's report would have been down 6% for the year relative to 2022. So I think they're seeing, just as you commented on, some additional slaughter happening right now that may make annual beef production higher. Despite raising beef production, they were also raised then the fed steer price by $3. So we're now talking about a annual average for 2023 of $1.62. That's, Megan, getting much closer to talking about record levels. I believe back in 2014, 2015, we would have been somewhere around the $1.65, $1.66 for an annual average. So we're getting there. Now on the other side of this, we did see USDA chop 10 cents off of their estimate for corn prices as supplies grew and they have more ending stocks now in that balance sheet. The one that continues to surprise me is the strength in soybean meal prices. They increased that annual average by $15 a ton this week. If you look at South America, I think it's really been Argentina that's seen some cut in both corn and soybean harvests that may be a little bit responsible for some additional strength we're seeing on the oilseed side of the equation.
That Argentina soybean crop and corn crop, for that matter, really are about as bad as I've heard in recent memory.
So really big cuts, especially as close as we are to harvest from USDA, which again, I think points to just how serious that situation is.
The cattle producer I talked to earlier this week was commenting about the corn prices. Obviously, there's got to be a balance there somewhere, right? We don't want the corn soybean farmers to see significant declines, but that's got to be a little bit of music to cattle producers' ears, thinking about input costs and input prices, and being able to find a better profitability line, knowing that corn prices could definitely decline some this year.
Yeah, so yes, I don't wish corn producers lower prices, but that they are moving in the direction that is helpful. And again, I'll say, although we don't feed a lot of corn at the cow-calf level, those feeder cattle prices, I think, are going to depend a lot on where corn prices go moving forward. So dependent on the weather that unfolds in this country in 2023, and it's important to remind ourselves that we may not feed a lot of corn as cow-calf producers, yet that may be the most important thing we're going to watch here in 2023.
It'll be interesting too, because exports of corn have been so much lower this year compared to previous years. So if you see a decent or even a normal sized crop, I would assume that's going to push ending stocks that much higher because our exports are that much lower.
Yeah, absolutely. That's the scenario that's playing out. I guess I won't be completely surprised for further upward adjustments to the stock levels we go out of this current year that we're in before we get to this fall's harvest. But all of that could really give us a much less positive corn S&U and lower prices. Having been on the road a little bit this week doing Outlook, that scenario, I think corn producers understand well of if it's really good weather and we put a 15 billion bushel corn crop in the bin and exports aren't strong and we go out of this year with more ending stocks than we earlier would have anticipated, we're not done going lower probably on corn prices.
All right, let's move on, talk monthly trade data. As you take a look at those January 2023 numbers, let's start first with beef exports.
Yeah, on the beef side of the equation, Megan, January came in 45 million pounds less than where we were a year ago. That's really due to both what was happening in South Korea, who's down a little more than 30 million pounds January over January, and then China, Hong Kong, Taiwan together are also down about 20 million pounds. Mexico and Canada were up slightly, so getting some strength there. The one that jumps out to me on the beef side of the equation here is the export value. In January of 22, it was $933 million of beef exports out of the United States. What we got this January was 626 million. So we lost almost 33% in value on that export side of the equation.
On the pork side of things?
Yeah, so it's nice to start to have a little more positive news. Perhaps the beef and pork industries are going to switch roles in terms of the strength or lack thereof of exports. January exports were up 45.5 million pounds in January. Two areas important there, and we can guess both of them without me saying anything. So Mexico and Canada up 18.3. That's really Mexico that was up, but also then China up 15 million pounds January of this year relative to a year ago, which then leads to a 15% increase in the pork export value for January. So better news on the pork side than we started 2022 with.
We're going to swap roles, at least for the month of January. It's really surprising, though, to see that beef export value pull back after really back-to-back years of strength and growth.
Yeah, that's right. I think just as you and I often talk about weak economic activity in the United States and what that means to beef demand, I think we're seeing a little bit of that happening with our trade opportunities. And you have some countries who are probably pulling back a little bit, just concerned about general economic activity in their country.
Jobs report came out on Friday. Numbers well above pre-report estimates.
Yeah. So I continue to be amazed at what in the past, and I say past, years ago, when we would talk about a jobs report that was in excess of expectations, we would get excited and markets would move higher. Now, when we get that same report out with the 311,000 jobs that were added in February, above the 225,000 pre-report estimate, it makes markets go down because everybody then says, well, Federal Reserve has no choice but to keep raising interest rates because we aren't slowing the economy. It's quite an interesting dynamic that we have going, but although more jobs might mean more money to purchase beef and pork, it probably also means inflation continues to stay relatively high and interest rates likely continue to go higher. We'll see what the Fed does in their next meeting.
As it's such an interesting dynamic, thinking about how this ultimately kind of it's a chess match, right? Like, let's see if we can do this to trigger this response. Have you ever seen an instance where it's been the response that you would expect consistently being the opposite response, especially thinking about we continue to keep adding jobs and not just a few more jobs than pre-report expectations, we're adding a significant number of jobs compared to pre-report estimates.
Yeah, we're stepping on the brake and the accelerator at the same time, and the accelerator's winning right now. It seems like when you look at the jobs number, I'm sure the Fed's felt like they've been stepping on the brake pretty hard, because when you look at the increases we've seen in interest rates, it's the most aggressive we've been in probably the last 5 cycles of higher interest rates, which go back a long time. Yet it's like the economy continues to push forward. Of course, you always worry about when the breakout outweighs what we're doing on the accelerator side, and then just how hard that downturn is. But we tend to be trading on information that's the minute of the day, and sometimes it's counter what we would have traditionally seen markets respond.
Definitely. Do you get nervous about, obviously, if inflation or interest rates continue to go higher, everything is more expensive, right? So how does that, if wages aren't keeping up or even holding steady or moving higher a little bit with the rise in cost of things, how nervous do we get about being able to continue to support demand and have demand support on the beef and pork side?
Yeah, so I think you hit one of the issues I talk about a lot. So I sometimes say I can't tell if the general economy glass is half full or half empty, and I look at this data when I say that. So disposable income projected for 2023 and 2024 by most folks would suggest a 6% growth in disposable income. So you and I have more money in our pockets. Unfortunately, when you look at personal consumption expenditures, coming off of 2022, where those had grown about 9%, some of the forecasts today would suggest 3 to 4% growth the next couple of years, which, again, I think we went on a binge in 21 and 22 in particular about consumer expenditures. And that binge required us to get a lot of plastic out of our wallets to pay. And those credit cards are getting, I think, fuller than they've been for a while. So I do worry that interest rates are going to choke off. And it's hard. This is, I think, the hard part of what the Fed has to do. How do you slow demand without stopping demand? I wouldn't want to be in their shoes trying to make those decisions, but we certainly could overcorrect. And then I think that gets tough, especially of all the ag commodities. I think especially the meats in particular are the ones that could see the biggest impact from that.
Scott, as we look ahead to next week, what reports do we have?
Yeah, so we get retail prices, and then we finish the week with another cattle on feed report, which we'll want to see how tight we continue to get, and also finish the week with consumer sentiment.
Scott, it's always great to see you. We will see you on Tuesday for our bottom line webinar on Brownfield, our content partnership and our partnering program with the National Cattlemen's Beef Association. You and the wonderful Kenny Burdine from the University of Kentucky, and we'll talk all things LRP and risk management for the future.
I look forward to it, Megan.
Have a great weekend. We'll talk to you on Tuesday and then again next Friday. I'm Megan Greffner for Brownfield.